legit. Anything you want.
This is the one chart every trader should have taped to their screen. After a year of tapering, the Fed's balance sheet finally captured the market's attention during the last 3 months of 2018. By the start of the fourth quarter, the Fed had finished raising the caps on monthly roll-off of its balance sheet to the full $50 billion per month, peaking at $30 billion USTs, $20 billion MBS, although on many months the byte per second does not actually shrink by this full amount, which depends on the redemption schedule, and by Q4 markets also experienced some of the largest volatility and drawdowns in nearly a decade. As no more, as George Concoves writes in a Friday letter, whether it was a coincidence or not, broader markets questioned the Fed's original view that byte per second roll-off was going to be like etching paint dry. Indeed, recent Fed speak has shifted to being more open-minded, with Fed policymakers suggesting that they are prepared to be flexible in implementing their balance sheet policy. The reason for that is that as both the market and the Fed, and especially Chicago Fed President Charles Evans, were violently reminded, just as QE added liquidity and boosted all asset prices, so QT is draining liquidity from the system. Worse, as Marko Kolanovic wrote in his latest report from January 16, given the recent collapse in liquidity and the toxic feedback loop of low liquidity volatility which we discussed last week, investors are very attentive to monetary policy measures that may affect liquidity. And since the most closely watched metric of systemic liquidity is once again the pace of the Fed's balance sheet change, and specifically, reduction, Kolanovic notes the recent example of a sharply negative market reaction to the comment that balance sheet reduction, quantitative tightening or QT, will be on autopilot, and positive reaction when the statement was later modified. Additionally, even casual remarks on the balance sheet has dramatic and significantly negative intraday impacts on markets, such as Powell's recent remarks that the balance sheet should be substantially smaller. But why, Kolanovic asks rhetorically, is there such a focus on the Fed's balance sheet from investors? The answer is obvious. By now only clueless hacks will deny that adding liquidity in the form of QE was the single, most important factor driving asset classes higher over the past decade. According to J.P. Morgan, the impact of QE was 20% of equity prices. See the bank's report here. Yet while qualitatively the answer is simple, complications arise when one tries to quantify the impact of the balance sheet shrinkage. Specifically, as the JPM Quant notes, the questions investors struggle with are how negative will be the impact of the QT. To wit, it is plausible that dollar for dollar, QT has a significantly larger impact than QE. The reason for that, according to Kolanovic, has to do that maybe the previously discussed fragility feedback loop. During QE, both central banks and investors, and certainly HFTs and algos, would broadly buy assets in an environment of low volatility/increased liquidity when the impact is small, while during QT assets are typically sold while liquidity is removed, compounding the negative impact of other outflows. Others have also tried to quantify the impact of QT on risk assets, most recently Morgan Stanley, which last week calculated that every $20 billion decline in mortgage-backed securities held by the Fed leads to a 0.37% drop in the S&P. Curiously, MS found that S&P 500 returns are not significantly correlated with changes in the Fed's Treasury holdings, although that observations will surely be retested soon. As a result, Morgan Stanley calculates that based on the recent MBS runoff of $15 billion per month, he projected S&P 500 return impact is minus 3.3% for 2019, with the real estate sector hit the hardest. Yet while Morgan Stanley believes it may have found the causality link between the Fed's byte per second size and its impact on the market, JPM disagrees, and in his note Kolanovic assets that owe his knowledge, there is no broadly accepted understanding of the exact mechanics and magnitude of QT's impact. For example, how much it is a signal to the market, versus mechanical supply-demand and price impact. Instead, he suggests that while there is a significant relationship between the Fed's balance sheet changes and the market, the big drivers of this relationship are: 1. The large QE programs were announced, such as March 2009 for example. When this point is taken out, the relationship no longer appears statistically significant. In other words, unlike Morgan Stanley's attempt to extrapolate correlation into causation, J.P. Morgan is more intellectually honest, stating that whatever the real mechanical impact of QT is, the indirect impact on market sentiment is likely much larger. In other words, stocks drop as traders expect QT to drain liquidity and impair stocks, selling in the process and resulting in a self-fulfilling prophecy. In a somewhat similar analysis, Nomura fixed income strategist George Konkove suggests a compromise option, noting that while his own analysis found little correlation of the smaller balance sheet to the S&P 500, unlike what was seen during the QE days where stocks had an eerie visual relationship to the actual size of the byte per second, he noticed weekly byte per second changes could be impacting markets. As an example, he notes that weeks where MBS holdings were paying down and/or weeks around the time the total size of the roll-off for both UST and MBS exceeded $20 billion, markets would come under pressure, if the most striking of those periods at the time being the February VIX shock. Additionally, in 2018 there were some hunky roll-off, and around those weeks there was market volatility and drawdowns, especially in late October and November. To fine-tune its analysis, Nomura looked at market performance for a few weeks after large roll-off weeks. It found that while in February 2018 it looks like the higher 10-year rates impulse was just as easily the driver of the S&P 500 declines a couple weeks later, by end 2018 the QT narrative was well entrenched, and then stocks would decline either before or after the larger roll-off periods. So, confirming Kalanovic's view that QT is a self-fulfilling prophecy, Konkove muses that perhaps markets were anticipating these moves and discounted them. Meanwhile, going back to Kalanovic's reflexive take on QT and the market, the JPM strategist notes recent intraday movements on balance sheet mentions, as well as the price action of the S&P 500 during Q4 shown in the chart below. So what does all this mean for markets? The answer remains generally unclear, with Nomura concluding that while it believes that QT is tightening, it is not straightforward and seems to come in rolling aftershocks of liquidity draining and markets adjusting positions. Meanwhile, the more actual impact of MBS QT on markets makes sense, as those securities are not zero-risk weight as are USTs and take up capital and/or need to be as substitutes for other credit products, which impacts FCI. Going back to Kalanovic, the JPM quant generally agrees with Nomura, and writes that while there may be little or no mechanical impact on equity prices, most macro traders will not fight the Fed, meaning when liquidity is added they are buying assets, and when liquidity is removed they are selling assets. In Ali, to justify his thesis that QT, for now at least, impacts markets largely as a result of feedback loops and quirks in behavioral finance, Kalanovic also notes that over the past months, we have heard a large number of anecdotes where investors avoid buying risky assets during or actively sell into weeks when there is a significant balance sheet reduction, g. traders taping the schedule to their screens, blogs and email chains, etc. JP Morgan's conclusion: whatever the mechanism or sequence of events by which QT affects markets, there is no denying that the shrinking of the Fed's balance sheet does affect the S&P in an adverse way. Balance sheet reductions put significant strain on market sentiment, on flows and on the weakest link in the market, liquidity volatility flow feedback loop. If the balance sheet reduction is a signal to sell, volatility increases, liquidity decreases, and additional systematic flows are triggered. As a result, Kalanovic warns that balance sheet-driven market fragility is thus increasing the risk of market disruptions and ultimately the risk of a recession, which is in contrast to policymakers' intentions. Naturally, one can argue this point very easily, and note that if true, then Kalanovic's assessment suggests that absent the Fed's balance sheet, the world would be in a singular depression right now, if indeed the modest shrinkage of the Fed's balance sheet from $4.5 trillion to $3.9 trillion risked a recession. Consider that there is still another almost $2 trillion to go before the balance sheet is renormalized, and one can see why the Fed is not only trapped, but will never be able to renormalize without jeopardizing both the fake market and global economy erected over the past decade on the back of $16 trillion in central bank balance sheet expansion, that is liquidity. But that's a problem for another day. For now, he'll conclude with the schedule that JP Morgan says traders tape to their screens, blogs and email chains, the complete QT calendar consisting of past and projected Fed balance sheet QT periods, courtesy of Nomura's George Konkove. Needless to say, self-fulfilling prophecy is most likely to be validated during the dangerous QT weeks which are highlighted in red, when the Fed's balance sheet shrinks especially aggressively, such as February 20, April 3, and May 1 and 15.